Today we're talking to Tyler Henritze, Senior Managing Director of Blackstone. Everyone knows Blackstone, one of the world's largest private equity firms. Tyler's done some amazing deals in his career, such as Hilton, the Cosmopolitan in Las Vegas, G6, equity office properties. We're going to find out where Tyler's head is today and how he sees Blackstone spending their time, energy, and money in this COVID world. Thanks for joining.
Hey, Tyler. Thanks for joining me today. You're looking good. You're looking real. Where are you? You don't look like you're at home. You're in an office somewhere.
I'm in New York. We are back in the office after Labor Day and happy to be here.
Did you call everybody in? Is that what happened?
We have invited back about a third of our workforce, which is predominantly the investment professionals. So we've got room to spread out, but those teams are back, and that was after Labor Day. It's still technically voluntary, but a lot of people are back, and it feels good.
Well, it's good to see you back. You're not hiding in the Hamptons anymore.
Not hiding out anymore.
I know. How's your golf game?
My golf game had been on a downward trajectory for 17 years working at Blackstone, and I think this summer, if there's one silver lining in COVID, my handicap actually improved for the first time in 17 years. So that's one small positive.
I was going to say, I didn't think they let you play golf at Blackstone.
It takes a global pandemic to be able to go out there and play a little bit. So I got a little bit more golf in this summer than usual, which is not a lot.
So talk about that, though, because I tease you that you're hanging out in the Hamptons, but for guys like us, especially you guys, Blackstone, it's work, 24/7, 365. So what have you learned in this pandemic to take a beat and pause for a second and hang out with the family?
Yeah, listen, I think I've always tried to have some balance in my life, but obviously that can be difficult at a place like Blackstone that's very demanding. But I think COVID has given all of us an opportunity to slow down a little bit. And early in COVID, had the opportunity with our oldest daughter to spend about 5 or 6 weeks with her grandparents, my parents, and some family. And we had time together that it's just hard to do in normal circumstances. At least that type of time. And for me personally, I think just slowing down a little bit has given me an opportunity to reflect on, what do you really care about? What really matters? My wife and I, we had a second daughter during this, which was an interesting, time to have a baby. But, I hope, myself and others and people on my team that it's given all of us a little bit of a moment to step back and sort of say, geez, was all of the craziness before going a million miles an hour, was that the right balance or not? And I've certainly been reflecting on that and am hoping that on the back end of this can minimize a little bit of the craziness and make a little bit more time for, friends and family and the stuff I love to do.
God willing that is the lesson we learned. I mean, I know you're a workaholic, right? And you wouldn't take any time off to spend time with the family for nothing. So I think it's great. I think you're supposed to. You never get that time back with the newborn and your first daughter, and you never get that time back. So cheers to you.
It was fun, and it's still fun. Like I said, we got a 2-year-old who's a complete toddler and who's crazy, and we've got a newborn. And so I've got my hands full with 2 little girls, and but that's a nice new wrinkle to life that's been a lot of fun.
Give me one moment. Give me one favorite family COVID moment.
Oh gosh. So my wife and I decided not to deliver in New York City. New York City's got great hospitals, but we decided to deliver out in Southampton. And when we were leaving the hospital, it's much less of a baby factory than New York City. We decided to kind of take a meandering drive home. And it was just my wife and I and our newborn in the back. First time we left the hospital. It was a beautiful Saturday afternoon. And we're just sort of cruising back from Southampton to our place in Amagansett. And it was just the 3 of us heading home to meet her older sister for the first time. And it was just a really nice moment of peace and quiet. The 3 of us sort of heading to, our second to be a family of 4. And it'll be a nice memory. It certainly beats the heck out of leaving the hospital and jumping in a taxi in New York City and scrambling through traffic. So it was kind of a symbolic moment of calm in the middle of COVID, despite the chaos that was about to ensue with a second child.
That's fantastic. And again, you get to be right there with each other on top of each other. Life's slowing down a little bit. Maybe there's something we can learn from it.
Absolutely.
All right. So before we dive in, I'm going to obviously get into how's Blackstone see the world and where you guys spending your billions of dollars and what can we, the humble people, learn from it. But I'm going to start with you. I like diving in how people got started. I know the answers, but share with us, how did the humble beginnings of Tyler Henritze as a child growing up in the small town of Atlanta, Georgia, how does he get to the big city and the big lights?
Teague, as you know, grew up in Atlanta. We actually went to the same high school, went to Westminster in Atlanta. I grew up in a big family, 3 sisters, 2 brothers. All the superstars in my family are the women. And, growing up, I had some siblings who were just amazing athletes, state champion basketball players, state champion volleyball players. I was like Mr. Average. I played a bunch of sports. I got cut from a bunch of teams, but kind of played a little bit of everything. And, maybe I had a little bit of a chip on my shoulder and sort of wanted to, do something at a high level. And so after going to UVA, I decided to go to New York initially for a summer. And I got to say that my first summer in New York, at least the first half of it, I was like, what is this place? I don't understand New York. This may not be for me. But I kind of got the groove down, got the hang of things the second half of the summer. And this was after 9/11. There weren't a lot of job offers. And when somebody gives you a job offer a week before your senior year of college, I think in 2002, you're supposed to take it. And so I took the job offer and started at Merrill Lynch doing real estate investment banking and, got grounded to a pulp, but met a bunch of great people and really fell in love with New York. And I think I'd always thought I'd spend a little bit of time in New York and earn my stripes and then maybe go back to Atlanta. My father's in the real estate business. I have some other siblings in the real estate business. My family's important to me. Always thought I'd want to be really close to my family in Atlanta, but had an opportunity after a year at Merrill Lynch to join Blackstone. Funny story. I'm out having drinks with a friend of mine from UVA, and he says, yeah, we had a first-year analyst who went home for Easter break and never came back. And I said, what do you mean never came back? He said, just never came back. And my takeaway should have been, geez, this sounds like a terrible environment to work in. But instead, maybe it was the couple of beers I had. I said, can I send you my resume? And next thing I know, I get an opportunity to start as an analyst at Blackstone. And I think what I realized pretty quickly at Blackstone was, the scope and the opportunity at Blackstone was tremendous. The people that I was able to work with, I expected it was going to be a bunch of jerks, that I'd learn a lot, but I'd be working with a lot of jerks. And I think the biggest surprise for me was just the caliber of people that I got to work with. People wanted to work hard. They wanted to win. They wanted to do right by our limited partners and do smart deals, but they wanted to do it in the right way. And I think that's probably as much as anything what I fell in love with about Blackstone was the people and the culture and being a part of kind of growing that. And so, a year goes by and then 2 years go by and you keep telling yourself, well, maybe I'll move back to Atlanta, here at some point. And I've been here for 17 years and I still talk about moving back to Atlanta at some point, but I think people have stopped taking me seriously.
You'll get there someday, but we haven't quit believing you. So I agree with you.
The good news is I've now got half my family in New York. So I've got 2 sisters who were both married in New York and then 3 other siblings in Atlanta. So there's at least a balance of power between Atlanta and New York. And so get to see my parents and my siblings and their kids a lot, which is great.
Yeah, you just sucked them all to you. Get Parker and the rest of them started following and yeah.
Brought them up here to the dark side.
Yeah, negative, really terrible influence. All right, so tell me about one of your first sort of big deals at Blackstone. What was it that you can remember? What was one of your first great deals?
Yeah. when I first joined Blackstone, I didn't know anything about underwriting individual real estate assets, but I had spent a year at Merrill Lynch tearing apart the kind of public universe of real estate companies, REITs. So I knew a little bit about public real estate companies and at least how to kind of analyze 10Ks and 10Qs. And around 2004, when I joined, John Gray was playing a bigger role within our business and really was starting to think about how we could pivot from thinking about individual assets to buying companies. And there were a couple of deals at the time that, my head was spinning because, these were big companies. Wyndham is one that comes to mind. I remember I was asked, we need to figure out a way to basically go and see about 20 different hotels in 20 different markets over a 4 or 5 day period. And, as a 24, 25-year-old, I hadn't done that much travel in 10 years. And all of a sudden we were talking about in a 4 or 5 day period needing to zip around and see all of these, amazing hotels around the country. And that was one deal that I think was, it was early on kind of in our transition from buying individual assets to buying companies. On the heels of that, we ended up buying Car America, which was an office REIT based in DC. Then we bought Trizec. And then the kind of the mother of all deals was when we bought EOP. And I think that's a deal I'll never forget. I mean, our entire team basically coalesced around that one opportunity. There was nothing else that was happening except buying EOP. And, even today, fast forward to 2020, thinking about buying a $39 billion business is just mind-boggling. And it was certainly mind-boggling at the time, and it was certainly mind-boggling to me. And I was, just happy to be a part of the team that kind of worked on it, and then got to work on some of the sales out of that. And it was a wild ride, especially when we got into kind of a bidding war with one of our competitors.
I remember when that happened, you were in the bidding war, but and it was equity office properties for those who don't know, EOP. But was it a good deal? Was it worth it?
Yeah, good question. So I think that it was a good deal. We set up the deal just before the downturn. We were fortunate enough to sell off a significant amount of the real estate, which we utilized to buy down our basis. And we were sort of high-fiving each other, thinking that we were in the chips, and then the world melts down. So we wrote down our investment pretty dramatically, and it didn't feel so great in 08 and 09 and the early part of 010, but we held strong. We stuck to the business plan. We didn't panic and sell assets in the downturn. We felt like what we had held on to was some great assets in LA, and an asset in New York, some assets in Boston. And we just sort of battened down the hatches and executed our business plan. And we had to write down the investment pretty significantly, but then we wrote it back up, and we ended up more than doubling our money on the overall deal. But it was certainly not without some harrowing moments in the downturn. But, I think you also learn in those moments to, not freak out, not panic, stick to your knitting, have conviction. If you bought great real estate, continue to reinvest in it, execute your business plan, and the markets will recover, and they did.
So one, kudos to you guys, but other deals. And the other one that comes to mind that you bought at the peak of the market, more famous for our industry, is with Hilton. We bought that in 08.
We probably bought Hilton at the absolute worst possible time you could buy a hospitality business. I mean, we looked like the dumbest people on planet Earth at that moment in time. But, really credit to John Gray and Ken Kaplan and Rob Harper, a couple of my partners. I think what they recognized was that in addition to just owned real estate, owned assets like the Waldorf, the business had this unbelievable asset-light management and franchise business, and these tremendous brands, in addition to Waldorf and Hilton, Hampton Inn, Hilton Garden Inn, and the likes, Conrad. And they really felt like this was a company that had global brand awareness, but had really not captured and taken advantage of that. And so again, despite buying the business at the worst possible time, we brought in what we think of as one of the best CEOs on planet Earth, Chris Nassetta, to help run the business. And he really realigned the culture of the company around a singular mission. and really accelerated the growth of the asset light management and franchise business, and particularly internationally, but also in the US. And so huge growth in Europe, in Asia and China, and in the US as well. And so as a result, while it was a bit painful during the downturn on the owned real estate, the asset light side of the business grew like a weed. And again, I think we wrote our investment there down to about 30 cents on the dollar. Ultimately, held on to the business. Did a restructuring during the downturn that bought us a little bit more time on our debt so that we could wait and sell the business at an opportune time. And then ultimately took the company public again, and then sold down our stake over a couple of years. And we ultimately tripled our money in Hilton, despite the fact that we bought the business at a tough time. And I think the two takeaways from both EOP and Hilton is, you don't have to be a market timer if you buy great businesses and great assets and you execute your business plan. Alternatively, there are deals we've done where we think we bought assets cheap at the bottom, and we should have never bought them, period. And I think there's lessons in that as well, just about high quality real estate and great leadership. In both instances, with Hilton in particular, we just had tremendous leadership in Chris Nassetta that really helped propel the business and create a lot of value for our investors.
Yeah, I think it's why you guys are, again, best in class. Anyone can do it when it's easy. You guys are rolling up your sleeves, really fixing businesses. And hiring Nassetta doesn't hurt. It makes you look really smart.
And it's easy when the going gets tough to sort of doubt yourself and think, geez, what did we just do? But like I said, a couple of my partners, John and Ken Kaplan, really, and Chris Nassetta, I think really had conviction in the quality of the business that we bought in the case of Hilton. And despite those dark days and dark moments, kept people focused on executing and didn't panic. And I took away a lot of lessons from that.
So the other deals you've done, I guess you guys have fallen in love with brands, right? You bought G6, Motel 6. You bought La Quinta.
We love the brand business. It's gotten a lot harder these days to compete with some of the big conglomerates just because of their systems and their investment in technology. But over the years, we've owned Extended Stay America a couple of times. We've bought and sold it a couple of times. We owned La Quinta. We owned Motel 6. We owned Hilton and their portfolio of brands. We own the Cosmopolitan today, which is a singular asset, but we think about it as a brand as well. And it's the leading, what we think of as leading gaming asset in Vegas. And so we love the asset light brand business, or controlling those brands as part of a hospitality investment, but certainly harder to find those opportunities today.
So let's go there. What are we looking at today? You guys don't buy pieces of real estate, you buy companies, as you said. So what are we looking at today?
Yeah, good question. So, when I think about my job, sort of leading our acquisition efforts in the Americas, I really think about it as trying to identify what are the demographic and technological shifts that are happening, big shifts, and how do those parlay into demand headwinds or tailwinds for different real estate asset classes. And so I've spent a lot of my time in the hospitality space, but sort of help oversee everything we do today within our acquisitions business. And we're constantly trying to identify those new themes and trends. And so before the global financial crisis in 07 and 08, our business was very heavily concentrated in office and hospitality. It was probably about 2/3 spread between office and hospitality. We talked about two big deals in EOP and in Hilton. Coming out of the downturn, we really started to look at the world and say, okay, what's changing, what's shifting, maybe as a result of the 08-09 downturn, and try to capitalize on some of those themes and trends that we saw that were emerging. A very significant one was the shift towards consumer preferences to buying online. And that sounds sort of like a no-brainer today, but in 2011, we really started very aggressively buying logistics and warehouse assets, purely premised on the simple thesis that people were shopping differently. And those goods that you buy on Amazon all have to go through a logistics warehouse. And we have continued to keep our foot on the accelerator because we don't see those trends dissipating. In fact, we see them continuing to accelerate. So today we own 860 million square feet of industrial around planet Earth. It's probably one of our highest conviction global themes. Obviously, pricing has gotten much tougher to generate sort of the opportunistic returns that we've been able to over the last 7 or 8 years in the strategy. But I'll give you one statistic, which I think sums up how the tailwinds in this sector are as strong as ever. In the first half of 2019, Amazon leased 7 million square feet of space. In the first half of 2020, when a lot of real estate was licking their chops trying to figure out which way was up, Amazon leased 58 million square feet. I mean, those numbers are staggering. By one broker estimate, Amazon is under construction with 100 million square feet right now that will deliver over the next 15 to 18 months. So if you think about, you know, maybe COVID is further gas on that fire, you know, further accelerant of the consumer's desire to buy online. But clearly, if you look at Amazon as one proxy, and a pretty important proxy for the industrial business, you know, their leasing demand I didn't even believe the statistics the first time one of my colleagues sort of sent it to me. I said, I don't think those are right. And he really dug in and vetted them, and it's pretty overwhelming. So, you know, it's those sort of mega themes that we're trying to identify and get ahead of. We took a public company private in about 5 or 6 years ago called Biomed. And what Biomed does is they own, lease, and build office space exclusively for pharmaceutical and life science companies. And we saw a trend towards certain concentrated demand pockets, specifically in San Francisco, Seattle, San Diego, and Cambridge, Massachusetts, where there was a real concentration of talent in and around the life science and biopharmaceutical space. And we wanted to be the leading owner of office space that catered specifically to those companies, because what they need is slightly different than what we at Blackstone need. They do very high precision testing. They need a higher air handling capacity, and they really need their space, you know, safe and secure for that type of work. And as you can imagine, you know, on the back end of COVID, the demand for that type of space is in significant demand. And so we are excited about that platform and trying to figure out other things to do. You know, another theme that I think has emerged more recently that we've been active in, and we did, I think, one of the larger post-COVID deals, we recapped Hudson Pacific's portfolio of studio spaces in and around Hollywood and LA. So think of these are basically sound stages and office space that cater towards the content creation economy. So Netflix, Amazon, Hulu, et cetera, are all pumping out content while we're all sitting at home trying to figure out how to get through COVID, watching all of this stuff. And our thesis is there has not been enough new supply in that space relative to demand for it. And to own that type of high quality real estate in the dead center of LA, right where all the talent is going to be a really valuable asset on the back end of COVID, especially as content creation starts kicking back up again and people are looking to replenish these content libraries that we've all kind of watched and depleted over the last 3 or 4 or 6 months, and they haven't been able to film new products. So that's another theme or thesis that we're excited about. And candidly, there are some historical things that we were overweight towards, which are tricky right now. And I you know, that we're trying to sort of sort through. I mean, you know, traditional office space right now, there's a lot of questions, I think, around, you know, what is the health and relevance of office space in a world where, you know, people can do calls like this. And, you know, we're not in the camp that everybody's going to do all their business over Zoom, but we're asking ourselves those questions, you know, which markets, which type of office assets will be most impacted positively or negatively. I think we're a little bit more constructive that the creativity that comes out of being physically in close proximity to your colleagues is really critical, especially for a lot of the creative and technology driven companies that are in some of the markets that we like to focus on, you know, think Seattle, LA, San Francisco, but there's real questions there, and there's differences of opinion. And I think it's those differences of opinion that create opportunity for people that can take a view on one side of that or the other and say, you know what, I'm not convinced everybody's going to work from home forever and always. I think there's opportunity there, and we're looking at some of that right now.
I mean, how do you guys see yourselves in the near future, maybe even the long future, but are you guys fundamentally net buyers or net sellers in the hospitality world?
I think there's going to be a lot of opportunity over the next year or two. And I think people forget how long sometimes these distress cycles take to play out. There's an anxiousness early on. People want to deploy capital. We've been a bit more patient. We did buy a pretty sizable amount of public equities in the hospitality space. Some of those rebounded really quickly. We didn't expect for those to be a trade, but we did sell out of some of those after they rebounded very quickly. Some of them have come back off. We're looking at a lot of opportunities and tracking a lot of situations in the hospitality space. I think there's going to be a ton of opportunity, but also are comfortable being patient. And there's not a lot that's transacting right now. The few assets that have, maybe, depending on if it's sort of select service or full service, some of the full service, you're seeing slightly bigger discounts of 30, 35% to pre-COVID levels, but not a ton of volume. And a lot of people, I think, are working with their lenders right now, getting forbearance agreements in place to kind of kick the can down the road a little bit. But I think there's going to be a lot of opportunity in the hospitality and leisure space. And we're, trying to position ourselves to get in front of as many of those opportunities as we can, but also being patient, recognizing that, we're not willing to underwrite a V-shaped recovery where things just sort of bounce back. You've seen a bit of a bounce back off the bottom today, and the stock market certainly has had a very healthy recovery. But I think in terms of the operating fundamentals within our hospitality portfolio, based on what we see in our own assets, and I think we've got pretty good insights there. We think it's much more of kind of a square root or maybe a Nike swoosh type of recovery, and we're more than happy to deploy capital, assuming we can underwrite a scenario like that. But if you've got to underwrite things snapping back overnight, my guess is we're not going to deploy a lot of capital. But I think we will, and I think there's going to be a lot to do.
Only a Blackstone guy would use a square root analogy for the shape of our recovery. But I digress. So I agree with you. So for my ask, I would think you guys would be out buying companies left and right. I mean, that's what you do, right? So, and I know you got your eye on all of them. I know you're watching everybody. It's what you guys do. You did make up a couple of the plays in ESA and others, which turned out you look like geniuses. And I'm assuming you did that because the stock was easier to own, get in and out of, rather than buying the actual company, where maybe a little trickier.
Yeah, I mean, I think since 1998, we have taken private 38 public companies, and it's been a huge part of our business. I think that those 38 companies represented about $170 billion in asset value, but it's not easy. You need the stars to align. You need a willing management team and a board that wants to transact. The price you offer has got to be compelling and at a premium to where the stock trades on the screen. There are a lot of costs and expenses that go into taking private a public real estate company. And so the stars have to align. And, there was a lot of dislocation in, certainly the early part of the summer. And because some of those opportunities we didn't think were necessarily immediately actionable, we did decide to just buy public equities because we felt like we could make attractive returns to our investors that way. And they were companies we generally knew really well. You mentioned Extended Stay America. I mean, this was not just a company on the screen that we didn't know anything about. We had taken the company private, and we sold it and then bought it again and relisted it. We knew this company very, very well. And there are a lot of companies that we always are think as attractive targets that we would love to own. But it takes a willing seller, and it's not as easy as just hitting a button and buying a share of stock. And so, sometimes you just see in these moments of total dislocation, management teams and boards don't necessarily just say, okay, let's sell here at the bottom. They want to do right by their investors and maximize value. And so, got to be a little bit patient on our side. But we're always trying to stay in front of those opportunities, and we've got a good bit of capital sort of that we're excited about figuring a home for, and constantly talking to a number of public companies.
You'll get something done. I'm confident. I'll pay attention to the headlines. So talk about dispos. Talk about your head. I'll give you credit, big time credit, because you guys were well ahead of the game in 18, 19 in disposing of a lot of your, at least hospitality real estate. I'll speak for us. I don't know if you saw something on the horizon or the cycle had been too long, but you guys were very successful in getting rid of disposing of a bunch of real estate of that. Talk about that a little bit, and then where's your head in the future?
Yeah, I mean, we didn't have a crystal ball, but we sort of always feel like there's you really can't ever solve for every risk that's out there. The easiest way to solve for risk is execute your business plan, not be emotional, and once you've executed your business plan, sell it. We've got a simple saying: buy it, fix it, sell it. At least as it relates to our opportunistic strategy. And so, you guys at Teague were very helpful in helping us dispose of a big chunk of our lodging portfolio, and it wasn't because we necessarily saw the end of the cycle coming. We were seeing rising labor costs and an increased supply, and we did feel like the cycle had been going on long. We did lighten our load, but we also made some new investments. We bought Great Wolf Lodge a year ago, and that business has been, like any hospitality investment, has been challenged over the last 3 months. But we are confident that as a leisure-oriented, drive-to, relatively affordable offering, that the demand for that product will be tremendous. And our rates, our average daily rates, even though we're operating with capped occupancy levels, in August was actually higher than what it was the year before, which is pretty remarkable. And so the demand is there. We just need to, be able to get back to normal. But on the dispo side, I think it was more luck than anything else. We just felt like we'd executed our business plan in the case of, a half a dozen or, dozen or so assets and a lot of our limited service and select service portfolio. We've still got our healthy share of hospitality assets that we're working through right now. But I do think on a relative basis, we kind of came into this downturn or into COVID with a much reduced hospitality exposure than what we have had historically. And we feel fortunate for that.
Yeah, better lucky than good, maybe, right?
Absolutely.
But keep going with that. I want to know your head on the dispo side, and we can pick on limited service stuff, or hell, we'll pick on the Cosmo if you want. But where's your head in dispo? You gonna, you know what? The world's moved away from these assets. Let's just go ahead and trade at whatever the market is today. Or no, we're going to hang on for 2-3 years before this world comes back because we're Blackstone and we have all the money in the world.
We are in no rush to sell. I think we're seeing pretty good pricing on the kind of the far economy end of the spectrum. So we're seeing, still pretty healthy liquidity in our sales, say out of Motel 6. But as you move towards the full service side of things, we have no interest in selling right now. We don't have to sell right now. We don't want to sell right now. Most of the assets we own, we're believers in. I mean, take Hawaii, for example, the Grand Wailea in Hawaii. Unfortunately, Hawaii is all but shut down from any sort of tourism into the market. And it's a tough period right now. But I can tell you, owning that asset fee simple on the beach in Wailea is truly irreplaceable. It's going to have a better day, and we've got the capital to make sure that we can hold on to that asset and sell, at the right time, not in this environment. And I think the same would be true for something like the Cosmopolitan. We're big believers in that asset. It's actually, based on the latest update, I'd say it is similar to Great Wolf, again, with lower occupancy caps than you're able to normally operate at, has been generating average daily rates in excess of what it did a year ago. We actually had gaming volumes for the month of August, both from a table games and a slot standpoint, that were actually right in line with what we did the same month the prior year. Obviously, the restaurant business is really slow. The retail business is all but done. The nightclub business is all but shut down. And we're only able to sell about half of our rooms. So, we're not making as much money as we had a year before, but the asset has been cash flow positive every month since it reopened. And our budget now for the year is up significantly from what we had forecasted back in June. So again, not to sort of jump up and down and high five yourself, but I'd say that we believe there's an enormous amount of pent-up demand for leisure and transient-oriented demand. Group's going to be slower, but your specific question, we're in no rush to sell. We're going to be patient, and we've I can't say we've been to this movie before, but as I referenced with EOP and Hilton, we have seen these moments of dislocation before. And as long as we believe in the assets and believe fundamentally in the real estate that we have, we're gonna sit tight and hold on for a better day.
So I want to keep going down this. So, because I agree with you, economy is on top, luxury is on the bottom. The inverted world that we're in right now. It's great to hear that we know the leisure travel is coming back with Great Wolf. It's great to hear the Vegas travelers sort of coming back. Those people, we still need the business traveler to come back for our industry. That person is nowhere in sight.
Absolutely. I mean, listen, I think pre-COVID, if you thought about sort of the segment mix, it was basically 50% business transient. I think it was 30% leisure and 20% group. And that's pretty much flipped. It's now 60% leisure, 30% business transient, and 10% group. And, when I think about like when I look at hospitality assets, or we're thinking about the relative risk of making new investments, I really think about it along kind of three metrics. One, is it a drive to or fly to asset? If you got to get on an airplane today, unfortunately, that's just another decision that the consumer has to make that they're not willing to make right now. So that's sort of one metric. Number two, what's your mix of business? Is it a purely leisure transient oriented asset, or are you surviving based on group business alone? Obviously, as we've talked about, very different dynamic there. And then the last one, which you touched on, is cost structure. There's just a lot more labor, a lot more operating leverage in a luxury asset than there is in an economy service asset. Your break-even occupancy thresholds are a lot lower for limited service and economy segment hotels. And so as a result, those assets from a profitability standpoint and a cash flow standpoint have weathered this storm a little bit better. So those are sort of the three paradigms I think you can kind of look at the entire hospitality universe through and answer who's performing better or worse, at least in this environment, from a cash flow and profitability standpoint.
How long do you think that remains? And when does this change? Is it post-election? Is it post-vaccine? Or is it still a long, long slog before we get anywhere?
Yeah, I think, again, I think that you're already seeing people on an individual basis make decisions about travel, one-off here and there, that sort of shows a sort of at an individual level, a comfortness traveling. I think people want to travel, and I don't think that long-term is going to dissipate. I think our view is that on the group side, 2021 is going to be another slow year. And I think my personal view is that on the group side, you could see a real rebound in 2022. But I think even with a vaccine sooner than that, I think 2021, as far as group business, is going to be a bit tepid. And people are going to punt on, having big, large format type meetings. And but I think you could see a real recovery in 2022. I would say on a fundamental level, we still believe in the basic human desire to gather and connect with people, both on a personal level for fun and from a group standpoint. And yes, there's going to be some meetings that you don't need to fly cross country for, that you can do, like we're doing here. But I think that we are not in the camp that, the long-term basic human desire to travel and connect and be with like-minded people and, talk about business or go to weddings or go to conventions is going to be impaired in the long term in a meaningful way.
I think you're right. Amen. Tyler, give me some generic words of wisdom that you got out there for everybody before I let you go, before I let you run. Tell me what you're thinking.
Words of wisdom. I would say, when I was in college and took a bunch of real estate classes or finance classes, whenever I had to take a class on organizational behavior, I thought it was a complete waste of time. And it's probably only been in the last 5 years at Blackstone that I've appreciated the power of having a team and a culture that's really all aligned around a common mission. And I used to think that was all happy talk and sort of cheesy and BS. And I think I've really seen it through this dislocation when our team, at least on our acquisitions team in the U.S., about 60 people, has all been working remotely. I think your culture is kind of put to the test, and you really see what people are made of. And I've been blown away at just the caliber and thoughtfulness of our team during this challenging period of time. We haven't stopped playing offense. We've had to play our share of defense, but we haven't stopped playing offense. And, people have really come together and been supportive of each other, even as we're all, staring at each other on computers all day long. And so, I guess, I would just say that, it's only reinforced further my belief that, culture and having the right team is ultimately makes me look good, makes Blackstone look good, and makes me really proud. So that's probably maybe, I don't know if it's words of wisdom or stating the obvious, but it's been reinforced in my mind, the importance of that over the last 6 months.
Yeah, amen to that too. And I'll echo, the Hunter team has kept us afloat and alive and motivated during these struggling times. It's unique. We don't know what we're doing. And you come up with creative ideas like Teague Talks and the like, which, have been very well received. So I'm going to not try to quit my day job and go join the industrial warehouse world right now as we hang up.
Hang tight. There's going to be industrial assets are trading at 4 caps. There's not a lot of meat left on the bone. I think you're in a good spot in terms of investment activity over the next year or so. So, where there's dislocation, there's opportunity, and you're right in the middle of it. So I think you're going to be very busy, and Teague's going to be very busy.
We hope. We're rolling up our sleeves. We're working our tails off right now. We're ready for the production to show up. But
yeah, it's going to come. It's going to come.
It's great. It'll be here soon enough, right?
It should.
Who knows? All right, stay safe, Tyler. You're a great friend. Hey to the family. Hey to everybody. And keep fighting the fight at Blackstone.
Absolutely. Take care. Thanks for doing this. Thanks for having me on.
Thanks, brother.
See ya.
See ya.